In this video, I'm going to show you exactly why I made what most people think is the craziest decision in property investing. I sold 9 residential properties to buy just 1 commercial property. And I'm about to prove to you that this insane move is actually generating more passive income than those 9 properties ever could. Now, if you're like most property investors, you've probably been told that success means building a massive portfolio, 10, 20, maybe 50 properties. The more properties, the more successful you are, right? I used to think the exact same way. I was obsessed with the numbers. I wanted to be that guy at networking events who could say, yeah, I own 20 properties. But here's what actually happened when I had 9 residential properties generating around 50 grand in passive income. Interest rates started climbing, my cash flow got squeezed, and honestly, managing 9 properties became a nightmare. I was spending more time dealing with property managers, maintenance issues, and tenant problems than I was enjoying the so-called passive income anyway. So I did something that made every other property investor think I'd lost my mind. I sold 7 of those 9 properties and bought just 1 commercial shopping centre for $3.175 million. Today, I'm going to break down the exact numbers, show you why this 1 property generates more passive income than my entire residential portfolio ever did, and explain why chasing property quantity might be the biggest mistake you're making. Let's get into it. I'm not sure if all you guys are new to this or seen my past, but generally I'm a fully qualified structural mechanical design engineer. Went and worked in robotic limbs and defibrillators and all this cool medical equipment. Then got into mine design, which is like big steel structures and machines and stuff like that. I'll be honest, it paid better. Instead of paying 70, 80 grand, it paid 150. So I got into that. And then this was in 2011, I started my research of property. So I bought a few books like Margaret Lomas, went to a few of the old school BA's presentations. So like, you know, the Nathan Birches and the Right Property Groups and went all that. And saw these guys, to be honest, making a lot more money than me without doing much, just signing pieces of paper, and went from there. So I decided, cool, I wasn't happy just earning 100 grand a year for the next few years. Let's do something else. So I grew up in Western Sydney, in Wentworthville, so I knew the Parramatta area fairly well. Even though I did my research, I still bought in my backyard, so I did what everyone did, but I knew fundamentally the suburb of Blacktown was up and coming, good transport, good diversification of ethnicities, access to work, population growth, hospitals and things like that. So bought my first property there for 230 grand. Within a year, it went up to around 320, 330 grand. And that was the light bulb moment. That was the jet, made $100,000, signed a piece of paper. There's something in this game, and then went full nerd mode and read every single book, listened to every single podcast, and then progressed to there. This stage, I didn't know anything about residential, so about commercial, just purely residential. So that was my vehicle. My strategy at the time was to build a passive income with residential. I was never one of those guys that actually cared about being a billionaire, having $100 million in net worth. At the time, admittedly, I was very much, I just wanted, it felt like I was progressing the more and more properties I bought. So that was, to be honest, the aim. The aim was to 50 grand passive income and to buy lots and lots of properties. What I actually found was everything I was buying was going great. Everything I bought went up 20, 30, 40%, which got me into the next one. I was the high cash flow strategy back then. So I was buying in areas like Foster and Cairns and Western Sydney and areas like that. Everything was positively geared. Luckily/unluckily, interest rates at the time were really, really low. So I actually got it up to around a 50 grand passive income and thought I was awesome. I was like, oh, how good is this? I'm working for 150 grand a year as an engineer, getting 50 grand passive income. I don't have to work, screw you guys kind of thing. And then interest rates started going up and that 50K wasn't as attractive. It didn't come down to zero because obviously rental increases, but it was just for something with 9 properties, I didn't feel wealthy anymore. I was just like, okay, this is a bit of a headache. To the point where, and this is going to sound a bit airy-fairy, is you need to realize when the enjoyment's sucked out of something as well, because I just did a podcast episode with someone actually, and we were talking about that. Unless you enjoy the journey, there's no point in doing it. You might as well focus your attention on business or shares or something that you're actually passionate about, because it is going to be a long slog. And I knew that was kind of my moment in residential. When I signed like number 8 and number 9, the contract, I was almost like, I can't believe I'm signing another property. This is annoying, gonna have headaches, etc., etc. It wasn't changing my life at all. Yes, it probably would have changed it in 10, 20 years time, but it wasn't giving me what I wanted now. So then when I became a buyer's agent, I started buying high cash flow residential for other people, then switched to commercial. So now I have around close to 1,000 commercial acquisitions under my belt. And that obviously opened up the world. The first commercial I bought was a cafe in Ipswich in Brisbane for 440 grand. Then next to the train station, freestanding block, 10 car spots. It's giving me around 39 grand, I think, a year at the time now. It gives me around 48 grand now. Probably worth about double now as well. I've still got that one. Actually, funnily enough, that's paid itself off. So just the rent going back into it plus a little bit extra savings, completely debt-free on that property. And that was the light bulb moment of like, okay, commercial, I can match that passive income with literally 1/9 the size portfolio. And then that was it from there. Not going to buy another residential. So this is the big thing for me. Most buyers agents call me crazy for it. I pretty much sold my whole Resi portfolio. Still got 2 of them. I'm undecided whether I sell them because they've got granny flat potential. So the yields somewhat comparable if I put a granny flat on them. Full disclosure as well, my partner's got a couple properties as well. So it's not like the headline of, oh, he sold his whole Resi portfolio. There's still 4 properties. Like we're still okay with that kind of residential route as a bit of a backup diversification. But I actually sold 7 of them. So I made about $3 million. So a big chunky kind of cash. I theoretically could have put that into a commercial. I could have just put it into a $3 million commercial. It's around 180 grand a year, passive income. That's it, done, dusted, retirement. The strategy I adopted was actually to break it up over 2 purchases. So I'm going to buy like a 3 mil one and another 3-4 mil one. The first one, which we'll get into. So being honest with myself of what actually makes me happy was probably the biggest takeaway I want from this webinar for you guys. So many of our clients, they just come and they go, oh, I want a 200K passive income. And you ask them why they want the 200K and they go, oh, I want to travel the world. You don't need 200K to do that. Like I was in Europe for 2.5 years when I started Palise Property and I spent around 120 grand. And that's not me slumming it. That was 20 countries, villas in Greece on the beach. You don't need that much money. And if you want that, that's fine, but be aware your time horizon's just going to extend out. You're just going to blow a 5-year plan into a 15-year plan and keep working a job that you potentially don't like. Whereas if you have that shorter term, more realistic goal, you can travel, you can change your job, you got more flexibility. Weirdly, the best thing, and I spoke about this quite a lot in the past, building a passive income makes work more enjoyable when you don't have to be there and do it. And that's why I build passive income. When I had a big Resi portfolio, high net worth, I didn't feel as wealthy as I do now with a smaller portfolio and a good passive income. So again, just assess what you're trying to achieve, what time frame, what you got to work with the finance, and then marry that up with an honest kind of reflection of what you actually want from your portfolio. So I worked out, I don't care about net wealth, don't care about Lambos, not some of those buyers agents that want to be a billionaire. Like, that's fine if that brings them happiness. Mine doesn't. Mine's family, hanging out with friends, travel, and work. That's it. So I've kept it that way. All right, so this is the property I bought. I bought an entire shopping centre it's called Regent's Park in the Logan area. I know the area quite well because I previously had 3 residential properties in the same kind of region. It's got 8 tenants, long leases. I think I had a WALE of about 4.2. I got this one for 3.175. One of the points to touch on here is I got it for a 6% net yield. Just remember, for you guys watching commercial stuff for the first time, net yield, not a gross yield. So if you get, say, a 4.5% gross yield in residential, you're going to have council rates, water rates, maintenance, insurance. That's going to be around a 2% net yield. If you buy a strong yielding asset, this is 6% net. So you're literally getting 3 times the cash flow. So just simply, you can have a 1/3 size portfolio for the same passive income as residential, which when people say, oh, it's high risk, well, you also got less debt risk as well. I'm mitigating risk. So this is purely, there's nothing special about this deal. Just a boring tick the box. It's somewhere to park my money that I know is going to guarantee me to always have a passive income. So that's what I liked about it. No stress, 3 times the yield, lots of leases and long leases as well. And then just a good set and forget. So this is in Regent's Park. I'll go through what originally brought me to this property. So found this deal. Again, nothing special. I actually presented this to 2 clients and they said no to it. And then after I bought it, they got all upset saying, oh, you should have pushed me harder. So I can't win. I'm either a slimy salesman or I'm not finding good enough deals. It's one or the other. So some of the reasons why they didn't actually buy it though. So this one's a 6%. So in Brisbane, you can actually buy retail. At the time I bought this, so this is about 9-10 months ago now. You could buy around 6.5% net for similar retail. So what I'm talking about though is, you know that when you're on a main road and you've got a parallel strip to the road and then the car parks are perpendicular, I can buy stuff like that for similar pricing at a 6.5. The reason I didn't was I actually like the land component on this one. So you can actually see, like, fundamentally with the Resi, land is everything. Scarcity is everything. This is 3,500 square meters. So that gives me options. Like, just the houses across the road in Regent's Park sell between 750 and 900K typically. So the ones across the road, like literally one of them sold for 890 a couple months ago. So I could always scrap this in 20 years time, build some houses. If they change the zoning to medium or high density, happy days for Steve. I can build multi-story apartments. Even at the moment, I could build residential on top. I could build an extra dwelling. I could put in like a car wash or something like that. Land just gives me options. The other kind of part I liked about how this was low risk, it's across from Regent Park State High School and across from a major kindergarten next door as well. So we're always going to have that 9 and 3 traffic. So people are always going to go to the food works as the anchor tenant or the hairdresser or the cafe or the fish and chip shop. It's good diversification. The other thing I liked was vacancy. So normally the biggest risk with retail is longer vacancy periods. One of the reasons why most people like industrial is because you can look at a vacancy rate, and most of the stuff we buy at Palise Property is generally kind of like the 1 to 3% vacancy rates. Some areas 0%, but 1 to 3%, which means on average for probably a similar value property to this, if you go spend around 3 mil, you're probably going to have a tenant on average 7 to 11 years is kind of the norm, and then you'll have like a 3 or 4 month vacancy. But with retail, typically you'll have maybe like 5 to 15 years, but 12, 24 months vacancy. So that's the risk. When we actually did our due diligence on this, and I'll go into a bit later, we had to do it up front and I'll explain why. We found there was only 2 vacancies in the block in the last 10 years, and the longest period of vacancy was 6 months. And I'll further attest to that. I'll go into a bit later about I actually kicked out a tenant about 6 months ago, and I'll explain what happened there. But yeah, so I figured worst case is one tenant leaves, I still get 7/8 of the rent, and we can kind of move on from there. So property was 3.175. This was a Burgess Rawson one, so they're actually notorious for not letting you have a due diligence clause. So most of the time you have to negotiate a due diligence clause. What I actually liked about this was there are actually 4 offers on contracts for the deal. So there was actually one at 3.2. I paid 3.175, but the 3.2 one had a finance clause and a due diligence clause. Lucky for me, I've got a team for due diligence, so I could actually knock that out in a few days. So we went straight into unconditional. We did all the hard work up front. But I've actually got 3 qualified valuers in my team as well. And they looked at it and they all said the property is about 50 to 120 grand overpriced. So as a owner of a buyer's agency with 25 staff, I consciously overpaid for this, knowing that when I worked out 75 grand, it's like 2.4%. So that's like buying $1 million property for 1.024 mil. Like, who cares? In the grand scheme of things, if it's worth 6 mil in 10 years time, that's not one. But I will always sacrifice that 2.4% to get a better quality deal, which is what I did. And that's probably a good takeaway as well, is people try to pick up a bargain on the way in. 2.4% is not gonna give you extra finance or change anything in the future. Funnily enough, I've made that money back, which I'll go into later. But I like that I had lots of people with offers on contracts and unconditional. There's 2 unconditional contracts Most of you guys don't get to know this information. I get to know it because I've obviously spoke to the agent. I've got a good relationship with them. And there was other ones at 3.1, which is probably more close to fair market price. But I'm like, if I ever need to do a fire sale for whatever reason, I get sick or we need money for whatever reason, I can sell it 3.1. Yes, I'm going to lose 75 grand plus some stamp duty, plus the selling costs, selling agent costs and all that stuff. But it's on the whole was a good asset and I like the tight vacancy and the versatility of it. All right, so let's go over some of the other pros. So mention the vacancy risk, the risk spread, so that's having lots of tenants, the development upside. I didn't mention as well the 60K depreciation benefits. That's also a kicker. Don't rely on that anyway, because what's going to happen when we go to the cons is depreciation comes back to you because you need to maintain properties as well. Buying retail over industrial, there's more maintenance and more headaches as well. So let's maybe go into the cons because this is the full transparent one. So one of the tenants I didn't like from the get-go. It was a tobacconist. Lucky for me, I'm buying lots of properties so I can just see insurance premiums, and my partner, Lisa, actually runs an insurance brokering firm. Insurance premiums are going through the roof for tobacconists because they keep getting firebombed. So something like 1 in 8 of them are getting firebombed at the moment and damaged. So even this year, that would have gone up to around 15 grand. The year after, most insurers are actually pulling out, which is actually a bit of a disaster if you own something like this, because if I can't get insurance for that shop and then that burns down and it burns down the rest of the shops, my whole asset's gone based on that. So even though the tenant was actually willing to pay more, they actually offered another like 10, 15 grand to look after the interest premium. There was end of the lease, I actually kicked them out. This will attest to why I still think it's a really good asset. We actually had 3 applications in the first 3 months. 2 were barbershops and 1 was a nail salon. I originally accepted the first barbershop that came in. However, then I found when I was actually doing some due diligence on the lease they wanted, they were planning to sell some chop chop, which is tobacco, illegal tobacco and stuff like that anyway. So the insurers wouldn't have touched it anyway. The next barbershop was legit. And again, I was fairly happy with them because the shop, the tobacconist, is actually next to the hairdresser. And that's a point to work on as well, is when you own a whole retail strip, tenant combinations actually has a huge play. You don't want to put a tenant that takes away from the types of tenants or the socioeconomic area. You want to kind of match them nicely to get as much foot traffic, road traffic as possible. The barbershop made sense. Next to a hairdresser, cool. You're servicing both males and females and go from there. However, a couple of weeks before we got the lease sorted, a nail salon actually applied. I like them better, had a better credit history score, other businesses, they gave proof of rental ledgers, and I think it's a better match having it next door to the hairdresser based on this location, because next to a school and a kindergarten, I think if someone wants to go get their nails and hair done, very good for them to do it before school, after drop off, in the middle of the day before kid pickup. It just worked well. So we went with the nail salon. The tobacconist was paying 30 grand rent. The nail salon's now paying 38 grand. So even at a 6% cap rate, theoretically 6.5 theoretically, that's about another 150 grand worth of equity I've made just from getting that extra 8 grand. So I've made back that $75,000 from the get-go, like literally within 6 months. So this is why I want to focus on, don't just pay, like try to pick up a bargain. If it's a bargain, it means there's not many people. I can tell you now, there are so many commercial buyers out there. There's idiots like me that have sold 50,000 books and got podcasts and does webinars, and I'm not even the biggest buyer's agent. There's other buyer's agencies that are doing it. There's other Resi buyer's agents doing it. There's a lot of interest. If you're buying a property and there's no interest, you need to second guess why you're looking at that property. So I've made that back already just by getting a good tenant. The other benefit is now most of the other tenants are paying $30,000. Because now I've got the premise and the baseline for 38 grand for that one, those other rents as they come off the leases will go up 8 grand. So all of a sudden I'm gonna get 150 grand times 7 other tenants. So there's another $1 million. So within 5 years, I'm expecting this property to be worth minimum 4 to 4.5 mil just from the rental increases. Ignoring cap rate compression, which is another capital growth factor. We can touch on that, but I think it's going down a rabbit hole we don't need to go through. But just buying quality, good rental increases will bring you the capital growth and the low periods of vacancy. You will do way better than if I went out and bought this in, and I'll use an example. We've bought a client a whole shopping center in Mackay for a similar value. Benefit of something like that is you get more bang for buck. So we bought in Mackay, we got about 7.2% net yield for it, but you get more tenants. So I think that one had 14 or 15 tenants. So more tenants, but then every time you lose a tenant, it's a longer period of vacancy. So that's you got to weigh up. Instead of having 3 months like I did, you might have 12, 24 months, 36 months, and that can compress. Then that's going to translate to lack of rental increases. So you're not going to get the uplift from the rent like I just got and make the capital growth. So it's that balance between rental increases, not getting capital growth, and chasing the high yield now. There's no right or wrong answer. Historically, it's proven like if you bought anything through, for me, in a good capital city, in a good area 3-4 years ago, it's worth 50% more now, and the rents have gone up 30 to 50% as well. Whereas if you bought in a really regional area, the rents haven't moved in the last 3-4 years. So I always focus on long term, look at the asset. In the next 10 years, is there going to be more demand for that asset? That will typically translate to capital growth and rental increases and low periods of vacancy. Some of the other things that were wrong with this property, the retaining wall out the back, it's on its way out. I might get another 10 years out of it, but you never know, like something might fall down there. That's going to cost a couple $100,000 potentially. So I got some rough quotes from builders and it's kind of like $100,000. I typically double it. So when I was saying, oh, it's great, I'm getting $60,000 depreciation, just be aware, we've got to take that off. If I'm getting $100,000 passive income from this, in 10 years time, it's actually only $90,000 passive income because you got the maintenance. However, you do that retaining wall, you then get depreciation on that, you get to claim that, comes off tax, etc., etc. The other thing I didn't like about this property, it's not on a main road. One of the big things with retail, foot traffic and road traffic. This one had okay foot traffic and road traffic because of the schools. And when I actually inspected this property, I actually sat there for the whole day just to look at it. There was that period basically from 9:30 till 11:30, it was pretty damn quiet. Then lunch rush came and all the tradies come in and all the other people come in. And then again, that kind of 1:30 till school time, it was quiet again, which is normal. You're going to have that cyclical one. You have the same thing if you bought in retail on the Sunshine Coast. It's more seasonal. Winter's quiet, but then summer's rammed all day, every day. So it's getting that balance right. It would have been nice if it was on a main road because there's more exposure, more cars going past, typically more options for value add with things like advertising boards or changing the tenancy to medical and things like that. That's one thing I'm keeping in mind on this though. So I've got my property manager keeping an eye out for medical. If he got a really big GP clinic and a pharmacy and says, hey, they like this spot, I will have a chat with my tenants and I won't renew their lease or I'll kick them out or give them an incentive. It just gives me options there. And then the last one is having multiple tenants is a massive headache. And I've plugged all the time that, commercial's low risk, don't buy residential, there's too many headaches with maintenance, etc. I'll be honest, I get an email probably every 2 weeks from my property manager on this and I pay them, I'm going to give you all the numbers in the spreadsheets to come. I pay them $20,000 a year because there is so much work with service contracts and picking up the bings and landscaping and managing all the tenants. There's just things that I haven't experienced. So we had one, I'll be honest, a guy got caught shooting up in the bathrooms. So we had to install an extra camera at the entry to the bathrooms and change the locks and do all that type of stuff. We've had a front glass break, we've had a leaking roof. We had people dumping, there used to be charity bins, for the clothes that you can put there. People just started dumping rubbish in front of them. So we actually, I like the feel good of having the charity bins, but we actually got rid of them because we started having illegal dumping. There's just all these annoying things that kind of keep going on. Again, my property manager emails me like, Steve, this happened. This is what I did to fix it. You okay with it? And it's like, yes. So in reality, it's probably 5 minutes every month or so. But again, just want to be full transparent. It's not like an industrial where it's just buy it, 3 concrete tilt-up panels, sit there, set and forget, happy days kind of thing. Tenant looks after everything. There's always going to be a clash of tenants and strata issues and roofs and maintenance and broken glass and cars parked illegally and cars dumped. And there's always going to be something. So again, just not sugarcoating. Maintenance is a massive pain in the bum in a big retail strip like this. If you bought one retail in a retail strip, you probably don't have those same headaches because you're not getting it magnified by 8. And then the body corporate and the property manager will kind of look after it a little bit more. But yeah, just want to learn there. One of the other ones that's not mentioned here is there's actually a laundromat there as well. Just be aware there are high insurance risk as well with high premiums. The way we got a low premium is don't have a 24-hour one. I know it's good in theory, but they don't like unattended ones. So you either have an attended one or make sure they've got a regime to keep the lint filters clean constantly, and that brought the insurance premium down as well. But again, just keep in mind if you're buying a laundromat, insurance is an issue, especially if it's 24 hours. All right, let's have a look at the actual numbers. So this is the biggest decision I probably had personally with the kind of, for this one, let's just say 1.5 mil, but like I said, I'm gonna buy 2 of these. Whether I actually leverage up again and go to a 70% loan to value ratio, or whether I buy something cash, or whether I meet somewhere in the middle. I decided somewhere in the middle, and I'll go into why that is, and it's basically because it gets me my passive income and I don't have to take on the risk. Disadvantage of leveraging up to the eyeballs, so I could have went to 70% and actually bought 10 to 15 mil worth of commercial. And if it all worked out nicely, in the following 10 years' time, I'd be much, much wealthier, because if you've got double the portfolio and it doubles in value and the rents double in value, I would be way more extremely wealthy in 10 years' time. However, I like the idea of that in the less than 10 years, I'll have a portfolio paid off, giving me a passive income with basically zero risk. Assuming there's not a major recession, I lose all my tenants. Very unlikely, I just reduce their rents anyway, but let's have a look at the numbers here. So I actually bought this for 3.175. Depreciation you see there is 28 grand because it's 60 grand worth of depreciation. So it's just working in the tax brackets. What I liked about putting the 1.5 mil deposit on this was interest rates need to go to around 13% before I have to start dipping into my own pocket. So that was a really important thing for me. I've got a 2-year-old. I like travel. I don't want anything affecting my lifestyle. So this is a nice way to preserve my wealth with lots of tenants without actually having to worry about like interest rates and all that type of stuff. I don't want interest rates to go high because then my cash flow obviously goes down. The pay down takes longer, but it is a nice little self-protective method. But you can see on the left-hand side, the cash flow is around 100 grand a year. It's actually a bit more than that now because obviously the rental increases of all the other tenancies and the nail salon. So the total return, you get around 266 grand a year. And then even at, you can see like 12.91%, it's neutral. So I really love that. Cool, I can hold this property long term. I got a lease stock loan on this. I could have went full doc, to be honest. Couldn't be bothered with business income and doing all that stuff. I just got the finance, knowing how short my pay down was. So it was just easier in regards to finance. But this is the cool thing. So let's have a look at, I'm not putting any money into this. I'm just letting it sit there and do its own thing. This is just a very rudimental spreadsheet, and you guys, the numbers I've been showing you on the last spreadsheet and this spreadsheet, go on paliseproperty.com, go to the resource sections. You can download these spreadsheets, have a play. You get the due diligence report, all that type of stuff. There's nothing special about this spreadsheet. All I'm doing is working out cash flow and then putting that back into the debt. I'm doing that once a year. It actually happens quicker in reality because you're doing it monthly and it shaves off an extra year. But again, it's just a good thumb suck figure. I got a 6.5% lease stock loan on that. Already that's down to 6.3%. So it's actually sped it up as well. As mentioned before, got the 20 grand depreciation, being conservative there. And like I said, the cash flow here says 87. It's actually around 110. But again, this when I did my due diligence initially, I took the bad numbers. And then all I'm doing here is that 87 grand cash flow, I'm putting back into the 1.5 mil debt. And then as you can see, as you reduce the debt, the cash flow goes up because there's obviously less debt. So the interest repayments are less. So your cash flow is growing and then you've got more money to put back into the debt. So you can actually see at year 8, we are debt free. And I've got a 240 grand passive income. Debt free, like that's it. And then this is where I came up with the number for 50% was if I buy 2 of these suckers, I'm $500,000 passive income from a 6 mil portfolio and I'm debt free. Like to get these numbers, we were literally looking at 20 plus mil portfolio and me doing this thing for the next 20 years just to get on par. I don't want to sugarcoat this. There's more to it than that. Like obviously missing out on leverage, and without sounding arrogant, not many people have a spare 1.5 mil to put into it. And that's the benefit of Resi. Resi gets you to have the capital to be able to do something like this. So unless you're a business owner earning lots of money, you will need Resi. And I bought my first like 3-4 residential properties basically with like 50 grand because you got the first one on 90%, next one on 100%, next one on 105%. So I built the base that way. I'm just doing the weird, stupid thing of selling it down to buy something cash so I can actually get that passive income and actually start enjoying it. In reality, I get asked all the time, like, oh, what's next, Steve? So I'm gonna buy another property. I probably in reality won't ever pay these off. So it's good for social media and these webinars to be like, oh, I'm gonna be debt-free in 7 years' time, yada, yada. I'll probably just let them get down to a comfortable level. So like if the 50% LVR gets to 25%, I'll probably pull out that 25% from the 2 properties, which will give me another 50% deposit, and then buy another one. So I'm still growing my wealth. I'm still going from 500 grand passive to 750, so on and so forth, and building my wealth that way, knowing that I've still got a really bulletproof passive income. I can see some good questions, and someone said about tax on the cash flow. Great question. I'll save that for the end. Yes, you're going to be paying tax on it, but I always find when I get asked that question, it's like you can't earn income without paying tax. It's just a fact of life. There's structures around minimizing it if you've got obviously negatively geared assets elsewhere and buying on trusts and company and that, but you're going to pay tax. Like, without no offense, whoever said Nigel, like, you're in a good spot if you're paying tax, and anyone you meet, if I'm like, oh, I've got a 500 grand, people go, oh, no, you don't, you've got a 250 grand. Correct theoretically, but what's the option? Have zero and don't live a good life? But like I said, there are mitigation techniques we'll maybe go to at the end there. But hopefully that makes sense. If not, download the spreadsheet, have a bit of a play, shoot some questions in the comment box or shoot me an email directly at stevepaliseproperty.com and we'll go from there. All right, so this is sort of what I alluded to at the start. So I'm just gonna talk a little bit about like, I did this at the start. I was like, oh, I want 10 properties. And then I was miserable at 9 properties. So I actually stopped. And then it became a passive income goal. And then I started buying really, really high yielding, low growth residential. And that was just too slow. And then luckily I became a buyer's agent and got to start buying commercial properties for other people, realizing there's value here. And I still remember the first commercial I bought for a client. And I was like, probably most of you guys being like, this person's an idiot. It's going to sit there vacant for years, no capital growth, all the usual myths. But I actually couldn't believe the numbers. That's why I thought it was too good to be true. Because back then, this is 2018, you were buying 7.5% to 9.5% net yields, and interest rates were down to like 3.5%, 4%. So you buy $1 million asset, we're talking like 30, 40 grand passive income from the get-go from one property. And then obviously I bought one, then I bought 2, and then I realized, okay, there's more to it than this. And then obviously you start doing due diligence and you realize they grow just as much. As I mentioned before, we literally just did a podcast in the other room there. And the client who bought a commercial through us 3 years ago for 850 grand, just had it valued at 1.6 3 years later. And it's like, oh, they do grow, obviously. So that was the really light bulb moment. But in reality, I can tell you this, and I'm not putting anyone down on this. I've worked with a lot of high net worth individuals. They're not any happier than the lower priced kind of budgets. It's what you do with that wealth. So some people handcuff them and buy a big principal place of residence, and that takes away their happiness. Other people actually enjoy their passive income, and they're the kind of happy ones. The ones that I find in the rat race of going. But again, just be true to yourself. Like for me, the image on the right, that's not me and my family, but close enough. I work 4 days a week, 10 till 4, spend Friday, Saturday, Sunday with my daughter, enjoy life. I travel 4 months of the year, I socialize a lot, and that gives me the confidence to actually do it. And that's what makes me happy. I've also worked for high net worth people. They get happy from growing businesses and making lots of money as well, which is fine. So that's where they spend their attention. So for them, it's no longer about the wealth, it's about the growing of the portfolio. So the main takeaway I want from this is just be honest with yourself, like without being airy-fairy, just like work out what actually makes you happy and then devise a plan to get there. Commercial obviously is a nice way to get there, and that's what I'm plugging how I make money through my business. But there are other methods. There's business and shares and residential and stocks and all these other quirky ways you can do it. So just find out which way you actually like. I've always liked commercial because for me, it's always going to need demand. I always get Resi people say, no, don't buy commercial, everyone needs a roof over their heads. And the joking thing I always say is, where does the roof come from? Like, I'd actually argue we need warehouses more than houses at the moment, because houses you can always build up. We can always build an apartment block to house people. You can't just have multi-story warehouses. So you're always going to need the car mechanics, the wholesalers, the fabricators, the distributors, storage, like everyone. Now, I'm upset when I order something online, it doesn't get to my house in 2 days. Like, I'm getting precious with that. That you need lots of warehouses. So I can actually argue commercial's lower risk than buying residential. One of the other things I've started realizing and saying on a lot of podcasts, and that is when people go, oh yeah, but commercial might sit there vacant for a long time. Cool, it might, but let's just say I bought a $1 million warehouse on a 5-year lease. And as I mentioned on this webinar, I'm getting 3 times the cash flow. So I'm literally getting 6% net versus 2%. If it goes vacant at the end of that 5 years and the tenant leaves, it could sit there vacant for 10 years and I'm still in a better position than buying residential. And when you pose it like that, it's quite a safe investment. The difference is you need the buffer. Like, that's the thing. Most people manage money really well week to week, which is why residential makes sense. They can work out, oh, cool, this property cost me $250 a week. I'm going to save that. Commercial, with that example I just said, you'd have to save the next 10 years worth of buffer from that 5 years and not get sticky fingers, not use it to buy another property. So just planning that way. Obviously, if you can't get a fresh 5-year lease and you get something for, say, 2-year lease left on it, and that went vacant for a long period, you need that buffer initially, and that's got to come from saving, which is harder. So again, not sugarcoating it, but just when you look at it long term, it's actually lower risk. Every single property that I've bought, I can tell you, has not been vacant 10 out of 15 years that it's been there. There's probably some bad ones you can go. That we hopefully don't buy the bad ones. We buy good capital cities with long leases, versatile premises, tight vacancy rates. But net long term, you'll actually be okay. Some lessons for you, and what I've learned over the last kind of 12 years of investing is don't just count numbers. It's really good for ego at the start, but for me personally, it was awesome to tell people I had 5 properties, I had 6 properties. After that, people don't care. You're still impressive to them. Your friends don't care. Your family don't care. For me, it's all about like funding lifestyle and getting that passive income, getting your time back. The other one we threw on here was the bigger isn't always better. I get asked every single day, people always say, oh, Steve, what's the perfect price point to buy a commercial property? Which I struggle to answer, because they're like, what are you actually asking? They go, oh, I want a good one at a certain price. But when do they get good? They're good at all price points. It's just how you actually look at it. I can argue that buying 6 $500,000 body corporate warehouses is a lower risk strategy than me buying a 3.1 mil shopping center, because I've got different locations, different tenant types. The body corporate protects me as well. As long as I buy ones with good admin and sinking funds, that insurance will cover leaking roofs and repainting the building, changing roller doors, all that type of stuff. Whereas I've got the risk, like I mentioned before, of the roof and the retaining wall. So there's not a bad one. The negative with the smaller ones is the tenants go more often. They come and go every 3 to 5 years because they're small, average Joe's electrical services, and that's the negative. But the vacancy rate's really tight. In a good area, you'll fill it in a month because there's lots of sole traders willing to jump on it, whereas a big $3 million warehouse, that's a 6-month vacancy, 12-month vacancy, but you get the tenant for 10, 15 years. So the takeaway is mainly buy to your budget that you actually have, unless something special is happening in the short to medium term. So if it's like, you come to me and you've got a $1 million commercial budget and you're like, oh, I'm not sure if I should save and try to get a 2 mil commercial. If we're saving any longer than, I'd say, 12 months, forget it. We could get 33% capital growth in that meantime anyway, and cash flow. If you've got inheritance coming or you're going to sell a residential, then that's open for conversation. But my brother and my team buys the little 500K ones. I don't want the headache, so I'm buying the bigger ones, and I've consolidated. You just find what's right for you. But to answer the question of what price point get you started, anything over 500 grand, you start looking at quality. You can still buy 300 to 400 grand, but just be aware you're getting 1-year leases. Lease docs are off the table. Bit more headache. Tenant's going to pay a bit late sometimes. You're going to cycle through new tenants. But again, you can still get good ones. We had one where we bought a 450 grand one, and the guy literally just uses it to store a couple classic cars, and that's it. And historically, he's been there for 10 years. He'll probably still be there for another 10 years. So you can still get good ones, but buy to your budget, buy to your comfort level. More importantly, buy to your end goal as well. And that's the point on the screen, is define your end goal and rough number. But for me, commercial's just been the game changer. If you know what you're doing, you can get 3 times the passive income, literally in a third the portfolio value, with as low risk if you know what you're doing. But they're the lessons there. We'll come back to Nigel's one about tax on cash flow. Really important one, and I can't stress enough, find an accountant that understands commercial, not just investing, commercial, they need to know it. And this is the pre-planning. You need an awesome mortgage broker, an awesome accountant. If you guys want introductions, again, just email me at steve@paliseproperty.com. I'll give you a list of the ones we work with and the ones we like. I don't get anything from them. There's no commissions or anything like that. Just they're good at what they do. But structures and finance is what kills most people's portfolio progressing. So just get that. There's ways around minimizing tax. So just FYI. So you can typically get it down to like the 30%. You will be paying it, but if your boss offers you a 50 grand pay rise, you don't say no, I don't want to pay an extra 25 grand tax. You take it, it's part of life, you move on there. There's obviously some expenses and things creative accounting you can do as well. Looks like you've got a 5% rent increase factored in every year. This is above CPI. What commercial class has bigger rent increases per year? Or what strategies can you get more favorable leases, higher built-in rent? Good question. So it depends what time frame you're actually looking at. Generally, increases on average of between 3 to 5%. So I've done 5% because that was in most of the leases. And for retail, and I'll come to your question because different prop asset types will have different rental increases. What happened with industrial, that's had huge rental increases in the last 3 to 4 years. Like we're talking 30 to 40%. So far outside the 3 to 5% I was saying. I wouldn't factor in 10% every year moving forward. I'd probably factor in 3 to 5%. So it's a good pickup that I was doing 5. But I've done that knowing that I'm probably going to get that because most of the tenants had a 5%. And the reason for that in my retail shop was post-COVID, everyone got concessions. Like my other commercial retail ones, you gave them concessions. You didn't just crank the rent up straight away. So most of the leases have been coming on. Whenever there's a renegotiation, and this is actually one of the negatives. I get a lot of people that love having a lease that might be 5 plus 5 plus 5. That's awesome, but you're locked into those rental increases for all the options. Whereas if you've only got a 5-year lease left on it and it comes to the end, you have to negotiate a whole new lease. So like I said, a lot of these were 5%. That's just my forecast of where we're going. If you want to change the spreadsheet, I can send you guys the copy of the exact spreadsheet. Reduce it to 3%. You'll actually find instead of it being 7.5 years payoff, it'll probably jump to 8.5, maybe 9. But again, I was using 6.5% interest rate. I'm now paying 6.2% interest rate. If that comes down to 6, that shaves a year off. So the spreadsheets are just illustrative. It's going to change based on your assumptions. Hopefully I get 30% growth, 30% rental increases. I don't know. It might stay exactly where it is now with today's numbers. I'm still happy with that. Interest rates could start going up again and it's going to be a slow one, but on the whole, I'm going to be okay. Like that's the main issue of why I put that big deposit in. That becomes a much more important question, Brad, if you're leveraging up, especially if you're pulling equity from another property. If you've pulled a 20% or 25 or 30% deposit from another property and you've got a loan to value ratio of 105, buying a 6% yield, that's a scarier proposition if interest rates go up to 8, 9, 10%. You need to be able to manage that. And then people go, oh, I don't want to buy commercial unless it's positively geared. It's still a better proposition than buying residential. If you go out and buy a 4% gross yielding residential, it's the same argument. You've just got more out of pocket. So I actually like the difference in commercial. If you go buy a 6% yielding one and the interest rate's are 6%, even at 100% loan to value ratio, it costs you nothing. Do the same thing for Resi, it costs you 30, 40 grand a year. So it's just working out like why we're buying, risk mitigating, what structures you're buying under, and then just deciding what you want from there. How do you factor in costs of a new lease or release within 50 years? Not exactly sure what you're asking. I'm just gonna freelance a little bit here. So there's some of the costs with leases. Obviously, every time you get a new lease, you're gonna have some solicitor reviews, and they can cost anywhere from $800 to $2.5 grand. If it's something like a little small retail shop, if you're buying a pet barn and it's a 10-year lease, different story, it might be 5, 6, 7, 8 grand. So there's money there. One of the secret things that don't get shown quite a lot, and I haven't shown it either, is actually releasing fees off the property manager. So they'll typically take, depending on the size of the asset, 10 to 20% of your first year's rent if you say get a 5-year lease. So we use round numbers. If I have 100 grand a year rent coming in and the tenant signs a new 5-year lease, the property manager is going to take 10 to 15 grand of that from year one, which people feel like is unfair, but it's because they've got to do the upfront work of lease negotiations, looking after, and it's just how they get paid. Like, that's to be honest, and that's why some people self-manage, which I don't recommend. Don't self-manage if you can. But yeah, there's that part. Then there's solicitors. Then there's the vacancy periods. They're the costs that will kind of add up. If you want a bit of a rule of thumb, I typically do around 5% contingency. Similar to like with residential, you have 5% for maintenance. I'll do 5% contingency for that. But again, it doesn't always happen. You sometimes get ones where tenant stays for 15 years and you just lose that releasing fee, and that's kind of it. So I hope that's answered your question. If not, just chuck it in again. Oh, good question from Menaka. How much are you putting aside year on year when it comes to repairs and maintenance, not tenant repairs? This depends on the type of asset, so I'll answer it twofold. For my retail one, I'm leaving all my money in an offset account and I'm not touching it yet, without being arrogant. Business is doing fine. I've got a passive income from my paid off other properties. So I'm not actually using the money. I've got enough money that I'm not actually using it. So that's just sitting there paying it off. To give you an answer, it's gonna depend on the property that you're buying. If you were buying an individual shop, you don't need much because there's a body corporate, they're looking after it. You might have some bits and pieces here. If the cost of something like a breakdown of an air conditioning unit or the front shop glass window and your tenant doesn't have insurance bothers you and you can't handle that cost, talk to an insurance broker. There's insurance for plate glass replacement and air conditioning machinery breakdown, and it's quite affordable. For a couple $100 a year, you can protect yourself for 5, 10, 15 grand. So there's ways around that. My one's a bit different because, like I mentioned, there's some bigger issues of like the retaining wall. Things like roofs always need maintenance and replacement here. So I'm probably budgeting around 20 grand a year on average, knowing that over 10 years, that's a couple $100 grand. That's going to give me 100 grand for the retaining wall, 50 grand for some roof issues, and just bits and pieces where we might have to tidy up, like we might get a pothole in the car park and things like that. But again, property dependent. If we switch across to say industrial, not much at all. Again, depending on what you buy. You buy a body corporate, they look after it. If you buy a freestanding warehouse, the tenant pretty much covers everything. So assuming it's like 3 concrete tilt-up panels and a roller door, the only real costs are machinery breakdown, i.e. the air conditioning, roller door, and roof damage. Again, you can get insurances for all of those. The roller door one, again, is really, really cheap because they're normally like 5 to 10 grand. So for 150, 200 bucks a year, you can actually cover yourself from that, or you can get your buffers. So to answer your question, it just depends on the type of asset and having a bit of know-how about what might go wrong and the contingencies you need to put there. But 5% is a pretty good rule. Again, if you're buying a really old rundown tin shed, that's completely different because you're probably not going to keep renovating a tin shed. You're probably going to knock it down and replace it sometime. So that one is a bigger play. You need to save a deposit to get a building contract to build a whole new one and then manage the vacancy. It's unlikely you're going to get some rent during that period. So you're not going to have a tenant and you're going to spend 6 to 12 months doing a development there. That's one of the benefits of, say, a commercial. Sometimes building industrial is actually quicker. We're doing a duplex in Kima at the moment, a high-end duplex. It's about an 18-month lead time for the build. That's for residential, whereas commercial, if you're doing a simple slab tilt-up, you can do it a bit quicker as well, so you can mitigate that risk there. When you first purchase the property for 3 mil, with rent, mortgage, cash flow remaining is around 95K per year. I can't see how it jumped to 250K. Okay, so the 250K, Anne, was after the pay down. So when we send you the recording, go back to the pay down calculator, where in 8 years' time, the property was debt-free. That's where I get the 250. So it's not instantly. I didn't buy the property and all of a sudden at 250. If that was the case, I wouldn't even talk to you guys. I'd be on my private yacht flying around the world doing all that type of stuff. So that is a pay down strategy. And that's why I did the 50% deposit. I could have got more than 250 in 10 years' time if I only put a 30% deposit down, but I wouldn't have that passive income in 5 years' time. So I want to spend time with my daughter and kind of think, I'll probably come back to work, she'll probably go to school and not want to hang out as much, and then I'll go back into work mode or some other type of business or whatever it is, but it just gives me freedom to actually pick and choose when I want to work. Hey Steve, for people currently building their base in residential property to raise capital and eventually jump to commercial, when would be the best time to engage with your team to strategize commercial purchases? Understand each individual is unique and has their own priorities. Probably worth chatting now anyway. Like, we're always happy to have a discovery call, see where you are and put you on the right path. Just so you know, I've purchased 1,200 residential properties and we buy around 10 residential properties a month for clients as well, so we can still help there. But if you're confident doing yourself or you've got a good relationship with another buyer's agent, always have a chat with us. We also offer just a property planning service as well. So if you want just us to come up with a good property plan for you, we have an online portal where you put in all your details and we can forecast when commercial might be right for you. But just reach out anyway. Everyone will attest. I'm happy to chat to anyone. So just shoot us an email with a bit of a background of information. We'll have a discovery call, maybe try to upsell you to our property planning, and then you can make a decision from there. Eddie, he's asked a question that I'm getting asked about 10 times a day at the moment. So with the 5% deposit scheme for Resi being brought forward, would it be better to ride that wave than move to commercial? So you've made a forecast, Eddie, of that Resi is just going to take off because of this 5%. People have been saying things of Resi going to take off for 30 years and it's been going well. Funnily enough, I actually don't think it's going to have the same kick that everyone's expecting. The main reason for that is in some of the capital cities, 70% of purchases are done by investors. So 20 years ago, it used to be 70% of purchases were owner-occupied, 30% were investors. That's flipped now, and I think that number's getting further and further apart. So of that, 30% of people are owner-occupiers buying in that market. So at the moment, it's only affecting 30% of the purchases. Of that, it's only going to be certain price points where people can get in. So I actually don't mind the actual 5% thing coming in because most people are paying rent. They can afford their mortgages. They just can't save the thing there. And let's just say they spread that 30% over different price points. So it's like one's sub 500, one's mil, one's 1.5. It's only going to give that kind of 5% kick of the market. It's not anyone who's like, oh, the market's going to double. How's it doubling? There's not twice as many people buying the properties. It'll give it a nice little kick in some certain areas. But again, that doesn't necessarily mean it's going to happen instantly. They all just haven't been waiting for 5 years and jump on it. It might be a long-term trend. I'm predicting only an extra 5-10% capital growth out of it. If you want to try to ride that wave, happy days. I can also counter argue that commercial's probably going to have a bigger kick at the moment. And I'm seeing on the ground stuff all stock, but I'm seeing way more investors actually buy commercial. 5 years ago, if I had a conversation with someone on the phone, and this is the reason I wrote my commercial book, they didn't understand anything about commercial. Literally every single phone call I had to explain like the tenant actually covers like the outgoings and how a lease works and how you still get capital growth. And people would look at me blankly thinking I was a snake oil salesman trying to actually get them into something that's not going to work. Go forward now, I've had 12,000 people do my commercial course. I've sold 50,000 books. I've had 500 people register for this event, and I'm just a little fish in a big pool. There's other buyers agents out there. So you times this number, and this is why I actually think, and this is where the data can't actually back it up, and I always say I use the data to make decisions. I'm going to make up a number here. 5-7 years ago, there was probably 10,000 investors in Australia who were buying commercial for an investment. Now, just me alone, I've got a pool of 50,000 plus people following me that are looking at commercial and willing to buy. So let's just say there's 10 other buyers agents and people doing it not through buyers agency. There might be 500,000 Aussies now looking at commercial, and the stock's actually getting less. So I actually see cap rate compression coming. And the two ways you get capital growth from commercial are rental increases and cap rate compression. I can foresee a massive kick in the next 3 years of commercial, hence why I'm going all in on commercial, of around 30-40%. If I'm honest, after that, I can see it tapering off, and it's going to be the economy and if Trump bombs the world and all that other stuff that I can't control. But just demand at the moment, yields are coming down. We used to buy 6.5% comfortably. A couple of years ago, we were buying 6%. A year ago, we were buying probably 5.5%. Now we're lucky to get 5% in front of some numbers. So Again, you can ride that wave, but it's just speculation. I don't think it's going to have a bigger kick. I actually personally think commercial is going to have a bigger kick. But coming back to that, if your leverage goes further in residential, then residential is probably right for you, unless you've got a short-term passive income goal of, I want to support my partner if they go on paternity leave, or I want to retire, and you need that passive income. If you can get away and put a 5% deposit on a property and go live there for a year, that is way better than putting 30% into a commercial and buying something literally 1/6 the size of that. Because if you are right and it grows by 30%, you're going to make 6 times as much, which means we could come back and buy a commercial 6 times the size. So the main benefit of residential is leverage. Like, you get to leverage up 80, 90, 100, 105% very, very easily. You use that to your advantage. That is the whole benefit of property, why it's better than shares in some instances. The only negative with the commercial, not the same leverage, more things to trip up on if you don't know what you're doing, and you can burn yourself. So use leverage to your advantage. If you're still got gas in the tank for residential, probably worth looking at that. If in doubt, let's have a strategy chat. Just reach out and we can have a call together. Is it worth buying in self-managed super fund, high interest rates with banks? Bianca, yep. So we buy quite a lot in self-managed super funds, probably around 1 in 4. Most of that just comes from people not being happy with their shares in the self-managed super fund, not doing anything, and they want a bit more control. So I personally think, not financial advice, but I personally think if commercial makes a lot of sense, because it's obviously easy to maintain that property. If you buy residential, you got to keep working, keep contributing that negative cash flow. Whereas commercial, depending on your loan to value ratio, it's not going to cost you much. Like if you go at 70% or 80% debt, even on $1 million asset, the point you raised, which is a good one, high interest rates, you're talking like 7 to 8% sometimes. It's going to be neutral, maybe a tiny bit negative, but if you earn 100 grand a year and it's 11 grand contributions, you absorb that very quickly and you can actually pay it off. And then it acts like a good retirement fund. And check out, we did a podcast episode with an accountant going through self-managed super funds. There's some awesome tax benefits, like having 200 grand passive income tax-free at retirement is powerful. Then there's obviously additional contributions, so your money goes further. The negative with self-managed super funds is you can't revalue the property. So it's kind of set and forget, or you've got to sell it and upgrade to another one. We get a lot of clients that still do value add. So they've got extra cash in the self-managed super fund. They buy something, they build a mezzanine floor, boost the cash flow by 30% that way, and then they'll obviously pay itself off quicker. But they've put capital into that they don't get back because they can't refinance it. But an awesome vehicle. Most of my team have bought in the self-managed super funds, and like I said, 1 in 4 people actually buy from Palise property in the self-managed super fund. So worth having a look. Talk to a financial advisor, talk to an accountant, talk to a good buyer's agent, talk to a good mortgage broker, get all those in line, and then make a decision from there. What was your lease and area WALE for the shopping centre? Oh, I can't remember off the top of my head. The general WALE was around 3.8, which was really strong because most of them on 3 to 7 year leases. I think the Foodworks was on a 7 year. Hence why I went like a lease stock loan. That I probably still would have bought this even if I had a WALE of 2.5.
Like my lunch.
Oh, someone's having some lunch. But I can't remember I'll send you the numbers. I got your email. I'll shoot you an email, mate. Any experience with clients buying commercial and a lease stock loan, self-managed super fund? Henry, have a chat with your broker. No, I don't think that's really possible. There's actually only a few lenders like Granite and that doing self-managed super fund. So you typically need an income to service that, to get that working. But you can get up to 80% lend. But again, if you need a good mortgage broker, just reach out, we can have a chat and we can go from there. How do you get rid of the tobacconist tenant? The agreement has expired. Yep, so spot on. The lease was finishing. Funnily enough, going into that deal wasn't as informed about tobacconist being an issue because it's only really came to light in the last year. I heard grumblings, but I didn't really care. And admittedly, I was just luck. Like if it happened another year's time, I probably would have kicked him out then. It was just lucky that 6 months in that the lease was finishing. That was one of the negative ones. So yeah, the lease had finished. What you can do, this is a case by case. So if anyone does own a tobacconist or they're thinking of buying one, you need to have a look at what's the actual recoverables. So if you buy the tobacconist and in the lease they cover 100% of the outgoings, the insurance is an outgoing. So theoretically, they need to pay the insurance. So that is a way to get them in breach of the lease. If They're paying 30 grand a year, and in this one they actually didn't. I'll be honest, it was a gross lease, so I didn't have this up my sleeve. But most of the retail will be a net lease. So if the insurance premium goes up by 15 grand that year, they're paying it anyway. So you say you have to pay this, and then if the insurance premium goes to 30 grand, they're probably going to have a chat with you and ask to leave anyway. So that's another way to get out of it. I'm not bad-mouthing tobacconists. I just want to they're not a bad tenant in reality. Like I look through the history of them, they always paid on time. It's just the insurance one becoming a bit of an issue. What one of our other clients did, they bought a tobacconist a few years ago before we knew about this issue. They actually just approached the tenant and said, do you mind changing your classification to a different type of store? And it's not as simple as just being like, oh, cool, we'll put a convenience store out the front. They have to still have the majority of their sales be in that other item. And they caught wind because they were like, hey, insurance premiums going up. They're on basically walking on eggshells anyway. They actually changed to a convenience store and they got there. I think the number was 30%, less than 30% of the sales could be tobacco. They got that under that and they started selling other things like drinks and bread and eggs and all that type of stuff and then transforming it. So they actually stayed on. So there are options. If you do own one, again, reach out. We can have a bit of a chat about your options there. If you own all the tenancies in a commercial property, how do you manage the strata management? Do you personally do this internally or use an external strata manager? This one actually doesn't have a body corporate, a strata, because most of them are on gross leases. My property manager manages all of this. Part of the process over the next 10 years is probably transferring them onto net leases and getting a body corporate. But the only benefit of having a body corporate is obviously working out outgoings for the tenants. And if you want to sell off individually, and if you want valuations to be more independent, so you can value individual ones based on like one's paying higher rent, you might get a better return. But it's just a cost and a management that I'm actually using. Because this is most likely a pay down and I've got a really low loan to value ratio, it's not really important for me because I'm going to keep the LVR under 50% anyway. Not going to ever have an issue with finance on it, assuming lease docs remain a thing, and even full docs, it'll look after itself anyway, so there's options there. But really good question. A lot of times you'll buy into a retail strip like this and they'll have a body corporate, and that will be quite important for you. Obviously, look at who it is, what their reputation is, what the admin and sinking fund levies are, if there are any special contributions coming up. You'll actually get a better history of the actual property because you'll see the last 5 years of what's going on. I had to fly in blind for this because the previous owner didn't really give me much. So that's why I went really to town on the building pest inspections. And it was a pretty simple building, so I didn't have to worry too much, but really good question. Ricky Moore, what's a buyer's agent cost like yours? Well, nothing for me on this one because I bought it myself, but generally most buyer's agents, we charge 1.8% of the purchase price, which is reasonably fair. Most buyer's agents charge kind of 2.2. Do you aim for higher cash flow or higher capital growth? 50-50 regional versus metro. I always play the demand strategy. So buy something that's in demand. I don't chase stupidly high cash flow. You will always perform better buying a property that's in more demand with a slightly lower yield. Because if you buy a bulletproof metro one at 5.5% net, where the vacancy periods are 1 month, that I can guarantee you in 5 years' time will outdo one where you buy one in the middle of far north Queensland where the vacancy rates are 10%. Because vacancy rates reflect demand. If I've got 1 month vacancy, there's some areas like North Sydney, for instance, it's 0% vacancy rate on warehouses. So like, you're going to keep getting rental. That will outgrow within a few years, depending on what the lease terms are and the market's doing. You will get rental increases and you'll actually exceed that higher 7% regional one, which will then translate to capital growth. And when you're looking at net ROI, you don't have the vacancy period, so that's not taken away from you. So this is probably the difference with Palise property. I'm not a yield chaser. I'm a boring, good tenant, good location, tight vacancy rate, versatile premises, demand buyer, because I know long-term you'll do better. And you'll sleep at night as well. You're not going to have that period where it's vacant for 6, 12, 18 months and you're sitting there at night being like, how long is this going to go on? I've got a big mortgage for it. So, but again, there's always a case by case. So I mentioned before, we've bought regional shopping centres for people because we wanted the yield. And the way you get around that is by buying the blue chip one because your money goes further. Like that one I'm talking about had a medical centre and a Subway and a Gloria Jeans bakery. Like it had some blue chip tenants. The hard argument for that one is we're like a 7.2%-ish yield is the capital growth one. It's like, okay, do we going to get the same capital growth? But that was an older client that we wanted the passive income and we wanted the low risk nature of it. And that's fine. I'm 38 years old. I've got time on my side. Chasing an extra 30 grand a year passive income is not changing my life. Business is good. I've got other paid off properties. I don't need that. So for me, it's the low risk one. So it's just marrying up that. If you had triple net leases, does the tenant cover all the maintenance? Yep. Great in an ideal situation. In reality, not always. You can say something like you buy a warehouse on a triple net lease. If the roof collapses, I can tell you you're going to get a phone call from your tenant being like, I'm not covering that. And you can take them to court being like, you're definitely covering it. But if you ruin their business financially and they can't afford it, like, why are you going down that rabbit hole? So you normally come together with agreements on those. But ideally, you want a net lease where they cover everything. The main reason for that is it's not changing anything in relation to your actual cash flow, because whether you got a gross lease and you work out the net lease anyway, it's the same result. You're still getting the cash flow. It's just more predictability over the long term of this is what I'm going to get. So when you're doing your forecasting, you can project your cash flow a bit easier because you're not going to have those curveball expenses come. Like if, let's say, council rates increase or the water rates or whatever it may be, you cop that for a few years. But what happens is at the end of the lease term anyway, when you do the market review, you're going to increase your gross rent anyway because it's fair market will come to the same. So it's a short-term dilemma. It's great in an ideal world. In reality, it doesn't change much. Like if you're saving 5% on your rent, for instance, for 3 years, cool, it's a nice little 15%, happy days, but in reality, it's not getting into the next property. I've recently seen a few sales and currently for sale that have commercial retail assets going along 75 to 100 placement childcare centres in Southeast Queensland on a single title. What are your thoughts on these types of assets? So childcare is, they're good and bad. Most people get sucked into them because they have a long lease. They got like 10, 20-year leases and people go, brilliant, I've got a 10, 20-year lease, happy days, I'm getting a 6% net. That all works well in theory, and childcares get valued a bit differently, so you can still do the cap rate method. A lot of the times they'll do it through how many children they have there, so they'll have a rate per kid, and that's how you can work it out, and that's another form of valuation for lenders. The one thing I don't like about childcare is they're very one-dimensional, purpose-built. And I know they seem like a guaranteed, oh, you're always going to need childcare. No, a lot of them struggled during COVID and things like that, and the ABC centres shut down. It might not be a thing in the future where they might have an oversupply, which, to be honest, I think an oversupply is coming. One seems to pop up on my inbox every single day now. If that tenant went bankrupt or struggled, you can't do anything with assets. A purpose-built, weird designed house, if I'm talking just like the residential type ones, that's going to cost you millions to repurpose and try to turn into something else. Then there's other ones that some people buy which are like office buildings. So they're like the second floor in an office building. That one's probably a little bit lower risk because if they leave, you can get an office tenant, which I'd argue is probably not a great tenant anyway, but you probably paid a premium for the childcare. So if they leave, you've lost value in that asset class. I'm not saying they're a bad investment. We've got clients that own lots of childcares and even masters at childcare. But like anything else, like self-storage, like hotels, like caravan parks, put them in that category. They are way harder than you think to make money. Like I know people pay their $180 childcare a day and they think, oh, they're milking us for all that money. But you got to remember, there's one staff member per 4 kids. So that's not a lot of money per day. Like once you take out that staff's cost of $250, they're making like $400 per little group. Then they got to like feed them, then they got to look after them, then they got insurance, then there's management, etc., council rates, whatever. They got all that type of stuff. So they're a good asset when they're done right, but be aware when they go bad, they go really bad. So I hope that answered your question there. I think we got through it, guys. Thank you so much for watching. Really appreciate it. Didn't expect this type of outcome for it. If you got any questions, literally shoot an email, steve@paliseproperty.com. I'm fully transparent about my portfolio, how's it doing, what I earn, all that type of stuff. But the main takeaway I want from this is just assess what you're buying and try to marry up with what you're trying to achieve with a realistic goal of passive income or portfolio size. Like be honest with what makes you happy and what you actually want, and then marry that up with a plan and then go from there. So that's the story of how I sold 9 residential properties down to buy 1 commercial property. The main thing I want you to take away from this is just be honest about what you actually want. Don't get caught up in the numbers like I did. I was obsessed with telling people I owned 9 properties, but I was miserable managing all of them. And if you're watching this and I've managed to convince you that it's time to swap out those resi properties into some commercial, let us help. We can help you find the right commercial deal, do the due diligence, and help you work out the right strategy. Now, if you're not quite ready to take that leap, but keen to dip your toes in the water, I have something for you. I've actually created a free 10-hour commercial course that covers the A to Z of commercial investing. We've had over 15,000 people sign up and do the course, so I think you'll definitely be able to find some gold nuggets of information in there. One more thing, having told you all about how amazing my shopping centre is, I do need to emphasise that I had to start somewhere, and that was with my residential property portfolio. All successful commercial investors generally start there. So if you're feeling inspired to start your property journey, I have something else for you too. Another course, but this one is for aspiring residential investors. Like with the commercial course, it covers everything you need to know about investing in residential property. Okay, that's everything else I needed to plug. Cheers guys, thanks for watching.